Good afternoon, everyone. I am Ritasha, Manager for Events and Membership at the Indo-French Chamber of Commerce and Industry for the Pune chapter. On behalf of the Indo-French Chamber of Commerce and Industry, a hearty welcome to all of you joining us today for this insightful webinar on evolving transfer pricing regulations in India. Before we begin, may I request you all to kindly feel free to post your questions in the chat box or the Q&A tab that you see and address them to the organizers and panelists. If you have a question directed to a particular speaker, please feel free to mention it in your comments. India's transfer pricing regulations have evolved significantly to align with global best practices and enhance transparency in cross-border transactions. In this webinar, our expert speakers will provide a comprehensive overview of this evolution, covering the historical landscape, key developments, and current regulatory framework shaping transfer pricing in India. This webinar is conducted in partnership with UJA Global Advisory. UJA is an Indian consulting firm specializing in strategic, legal, and tax support for French companies willing to set up in India, and also for Indian companies who are willing to set up in France. UJA covers a variety of sectors such as aerospace, medtech, biotech, energy, agrochemicals, etc. From the UJA team, we have with us today Olivia, who's the General Manager for France at UJA. We have Nitin Krishnan, who's the International Business Consulting at UJA. And our speakers for the day, Ms. Ritasha Talwar, who's a Senior Partner Audit and Assurance, and Shrushti Agiwal, who's an Analyst in Transfer Pricing at UJA. I will now hand it over to Olivia to speak a few words before we begin the entire webinar.
Sorry, I've just unmuted my mic. So good afternoon, everyone. And thank you to you, Richa, for this introduction of UJA. I won't take much of your time. Ritasha, if you can show the slide on the French desk, and our team would be lovely. So we are, as Richa said, advisory, accounting, and audit firm. We were founded in 1996 by Mr. Jain. And what you have to remember is that, some of you already know that, is that we're specialized in advising mainly European and Japanese clients. So all our Indian team, our 150 consultant, tax specialists, and legal experts, liaise with the European and Japanese team that are both in the respective countries and in India. So I'm, as Richa said, heading the UJA branch in France. And in this French team also work Joanna and Nitin, and both are based in India and speak fluent French. We have offices pan-India, Delhi, Mumbai, Pune, where our headquarters are, and Bangalore. And in Europe, we have offices in Paris, Marseille, south of France, Milano, and Tokyo. I think you have a few explanations on the left-hand side about what we do. I think from my end, that's all I have to say. And over to you, Ritasha, to start the presentation. Thank you.
Thanks, Olivia. Thanks, Richa, for the introduction of UJ, and also to have an introduction about a webinar also, which we are going to have today. A very warm welcome to all the attendees, and special thanks to IFFI for organizing this webinar. So today, the main objective of this webinar is to talk about the transfer pricing. So transfer pricing subject is always a very niche subject as far as the multinational enterprises companies are concerned. So everywhere, whenever we have to talk about a cross-border transactions, we always analyze the transfer pricing part. So as far as the today's webinar is concerned, we are going to cover majorly these 4 topics, which is there on our content slide. So first is the history of transfer pricing in India, like when transfer pricing came in India as far as our income tax law is concerned. Next, we are going to talk about the dispute resolution in transfer pricing. That is the major agenda of today's webinar. Like, as we know that disputes are always a part of any law. So how we have to resolve, whether there are any speedy methods, that we are going to discuss today. Apart from the same, the third topic which we are going to cover today is the amnesty scheme, that is Vivad Se Vishwas scheme. So these are the special schemes which are introduced by the taxation department in order to dispose of the litigations in a speedy way. And lastly, we will touch base upon the major transfer pricing updates which has been pronounced by the finance minister in the current budget, that is Union Budget 2025. So now we will move on to our first topic, that is history of transfer pricing in India. So transfer pricing, as we know, what is transfer pricing actually? So in case I have to talk about transfer pricing in simple terms, what I will say, it is simply a art of pricing. The cross-border transactions between the two or more companies which are a part of the same group. So when I say pricing, so what do you mean by pricing? So whenever I talk about a transfer pricing chapter, we always use the word arm's length price. So what is arm's length price? So in case we talk about arm's length price, the definition of the same is given in the OECD guidelines, which actually talks about that arm's length price is basically our fair market price. And how we have to determine the arm's length price, that is again given in the income tax law, that is given in our transfer pricing provisions. So in case I talk about the transfer pricing in India, so it was introduced in the year 2001 to prevent the erosion of tax base in India. Because the main objective of transfer pricing is that within the group, the transactions are not planned in such a way that we actually reduce taxes at India level or in the another country by transferring the profits in order to plan the taxation at a global level. So in order to avoid that, transfer pricing comes into picture. So where transfer pricing is there in our income tax law, in case someone has to study, then we are having the chapter number 10 of Income Tax Act, which actually gives us the like details about transfer pricing under the title Special Provisions Relating to Avoidance of Tax. So transfer pricing in itself is a very broad subject, which includes like your various methods of transfer pricing, then about the benchmarking provisions like function analysis, economic analysis. Then also we have to study OECD guidelines. So in case we consider all these things, then we can understand how actually transfer pricing works. So now we are going to talk about the evolution of transfer pricing. That is how, what are the major developments which happen in transfer pricing over a period of time. So firstly, we talk about advanced pricing agreement. So advanced pricing agreements, it was introduced in the year 2012 in India. So what is APA? We are going to cover, APA actually means advanced pricing agreement. So we are going to cover this in our further slides also. So it is basically, just to give you a glimpse, that advanced pricing agreement is basically an agreement between CBDT and the taxpayers, which actually gives you certainty regarding the transaction pricing as per the transfer pricing provisions. So how it actually works, that we will discuss later. Then in the year 2013, we are having safe harbor rules also. So safe harbor rules, it is also a very good development in transfer pricing in the context that it gives you it gives you a specific margins, or we can say acceptable margins for a set of transactions, which is given in law itself. So in case I adopt safe harbor rules, it means I am basically litigation free, because that is already accepted by the department. So that is also a good move by the income tax department. Then in the year 2016, we are having range concept, which was introduced, and we can use multiple year data while doing the benchmarking, which is applicable since AY 15-16. So that is also a good thing which we are using since that year in our transfer pricing study reports, during our benchmarking analysis. And then in the same year, BEPS Action Plan 13 was also introduced. BEPS, as we are all aware, it is basically our base erosion and profit splitting, which actually gives us the like various points which is actually accepted by the different countries. So BEPS Action Plan 13, it actually talks about the 3-tier documentation structure as far as transfer pricing is concerned. So what is 3-tier documentation structure? 3-tier documentation structure, it actually consists of 3 things. That is like our local file, which we all know. Local file is a file which we have to maintain as per the basic law. That is our transfer pricing study report, which actually gives us a FAR analysis, like your functional economic analysis, then your benchmarking and other things which is given in the law itself, which is given in our transfer pricing rules. And then we are having master file. That is the second thing. So what is master file actually? So master file is a file which we have to maintain in case we actually cross certain like turnover limit. Like as per the present income tax provision, in case our global turnover is exceeding 500 crore or your international transactions are exceeding 50 crore, then you are covered in the master file provisions. So master file report is actually a report at global level, which is actually a qualitative report. So when I say qualitative report, what does it mean? It gives you an overall analysis regarding the business, like what are the various transactions, what are the key drivers, then how the financing is handled. So there are a set of things which is given in the respective form. Like we are having various form, like form 3C, double A is there, then 3C, AB is there. So we are having part A, part B, which depends upon the applicability. And same way, apart from master file, we are having CBCR reporting. So what is CBCR reporting? CBCR reporting is basically country by country reporting, which also depends again upon your like turnover part, like what is the global turnover. Like as per the present provision, in case it exceeds INR 6,400 crore, then we are attracted by CBCR provisions. Again, we are having set of forms under the same, which is more a quantitative report because it gives you figures like your revenue part, then your taxes part, your profit part, your interest part. So both these reports, master file and CBCR, they are quite technical report in which we have to take the information at a group level and which has to be handled by the tax specialist. So we have to take help of the experts only. And then in the year 2017, we are having another amendments which came in law. That is like we are having secondary adjustment provisions and interest deduction limiting section. So secondary adjustment provisions, what are secondary adjustment provisions? So in order to understand secondary adjustment provision, we should know what are primary adjustment provisions. So in case the taxpayer has a transaction with the group company and that is priced at a X price. But as per transfer price, the price is Y. So what is the difference between Y and X? That will be my primary adjustment. So it means that transaction, when we are going to report a transaction in my income tax return, I am going to do the primary adjustment. So primary adjustment, it can be sumo that means the taxpayer is doing the adjustment on its own while filing the ITR, or it can be as a result of your income tax assessment, or it can be as a result of the advance pricing agreement, or it can be as a result of safe harbor provisions, and so on. So what happens that in case your primary adjustment exceeds a certain limit, which is 1 crore as per the present law, in that case, we have to do secondary adjustment also. So what is secondary adjustment? So secondary adjustment actually means that we have to do the entry in the books of account for the difference part so that my actual profit is in line with the transfer price. And we have to bring equivalent money from the group company. So what does it actually means? We are doing the reconciliation between the profit and the cash part. And also law also states one more thing, that we have to bring that money as far as secondary adjustment is concerned within 90 days from a specified date. And in case that doesn't happen, then it is considered as a deemed loan by the Indian company to the associated enterprise outside India. So that is something about secondary adjustment provisions. Same way, we are having interest limiting section also, that is section 94B, which was also introduced in the same year, that is 2017, which actually talks about that whenever we are paying interest outside India to associated enterprise and that is exceeding 1 crore rupees, in that case we have to limit the same. That means it should not exceed 30% of my earnings before interest, depreciation, amortization and taxation. So that is a limiting section. So that is something which is actually limiting your interest cost. Otherwise, the excess amount will be actually disallowed. So these are the various amendments, like various developments which came in transfer pricing, like APA, safe harbor rules, BEPS plan, and secondary adjustment provision. Now we are going to talk about our next part. That is our major part of today's agenda. That is transfer pricing dispute resolution method. Now, what do you mean by dispute? So dispute actually means that whenever there is any difference in opinion as far as law interpretation is concerned, or there is some compliance issue, then dispute is going to be arise. So in every taxation, in every law, there is always a basic system of dispute resolution. Like in case I talk about income tax, we have a proper process. Like in case of assessment, in case assessee or the department is not satisfied, in case the assessee is not satisfied, assessee can go to appeal. So in case of appeal, we are having various levels of appeal. Like we are having commissioner appeals, then we are having tribunal level, and again we are having court also. Like we can go to high court, we can go to Supreme Court. So as we know that the taxpayer has a right to go to different stages, but it is always time consuming, and it also requires cost also, because you have to pay to consultants in order to handle the case. And it also disrupts your usual business activities also, because if the assessment is going on, we have to prepare everything for submissions, and there are so many things which actually happen during the assessment process. So there is always a industry is always looking from the like revenue side, that there should be some alternate dispute resolution matter, so that there is a certainty which can be there in order to boost the industry. So considering the same, we have alternate dispute resolution matter in transfer pricing also, which actually gives a reasonable certainty to the taxpayers who don't want to take the risk. And this is good from revenue side also, because revenue can allot resources and time to high risk areas, because they can save their time and they can actually use that time for other areas, instead of allocating the resources in order to handle the assessments, in order to handle the appeals. So now we are going to talk about the various dispute resolution methods, which is actually there, which is applicable in India, and which is actually available to the taxpayer, and taxpayer can take benefit of the same. So what are the alternative dispute resolution mechanism? Alternative means it is not like appeal process. This is an alternative process. So we are having like first is like advanced pricing agreement is there. Then we are having safe harbor rules, and we are having mutual agreement procedure. So now we are going to discuss about all these three pointers in our next slides. Like what is basically advanced pricing agreement or safe harbor rules or mutual agreement procedure. So firstly, we touch base the advanced pricing agreement part. So what is advanced pricing agreement? As we just discussed in our previous slide, advanced pricing agreement is an agreement which is signed between the CBDT and the taxpayer. Now CBDT, we know what is CBDT. CBDT is basically Central Board of Direct Taxes, which actually is the ultimate statutory body which supervises the entire income tax, right? So advanced pricing agreement, it actually gives certainty to taxpayer, because what happened, it is an agreement which is signed between taxpayer and the tax administration for the future transactions, in which case we can actually freeze our transfer pricing methodology and transfer pricing method or transfer pricing margins also. So it depends upon the transaction, it depends upon the parameters on which advanced pricing agreement is signed. So as per the present provision, advanced pricing agreement can be actually executed for a period of 5 years. So it means it actually gives you certainty for another 5 prospective years. So it is up to taxpayer, like for how many years he actually, the taxpayer, he or it wants to go for the advanced pricing agreement. Further, we have a like provision of rollback also. So what does it mean? That I can actually apply for the advanced pricing agreement for the previous years also, and that time limit is like I can go up to 4 previous years. So we can see, we can actually visualize that it is like for 9 years we can actually use this advanced pricing agreement like system in order to give certainty to our transactions. Now again, advanced pricing agreement, it can be unilateral, it can be bilateral, or it can be multilateral. So what is unilateral? As its name suggests, it is very simple. Like in case you're going to have an advanced pricing agreement between the taxpayer and tax administration of the home country. Like let's say my company is in India, and I want to have an advanced pricing agreement for an international transaction. So I can apply for the same with the Indian tax administration. So that is unilateral advanced pricing agreement. But in case the taxpayer wants certainty for at a global level, like so, then they can go for bilateral advanced pricing agreement. So in case of bilateral, what is going to happen, that there will be like 2 tax administration. One is like your local, your home country, and one is the another another country, and one is a taxpayer. So that is the bilateral advance pricing agreement. So since bilateral, it includes the tax administration of the another country also, obviously it is going to take more time, and it also includes more cost. So bilateral agreement also includes the this authority from the competent authority of the different countries, because ultimately they have to talk about each other in order to arrive at a solution which doesn't actually burden the taxpayer of both countries. And then we can have a multilateral advance pricing agreement also, which includes more than one country. Like there are some transaction which includes more than one country. In that case, we can have multilateral advance pricing agreement. So advanced pricing agreement, since it actually focus upon the freezing the transactions for a future period, so it actually gives us savings in annual reporting cost, because your transfer pricing method is freeze, and then your comparables and all these things are free. So it actually gives you a saving. And same way, there is a reduction in the cost, which is linked with our appeals part and all, because our transfer pricing system, transfer pricing policy is already decided, and it is already accepted by the income tax department. However, we have to ensure that we have to do annual compliance also. So there are something which is done for post advance pricing agreement also. We are having post compliances also. So there is a compliance report which you have to actually submit to the department in a prescribed form. So that is a post advance pricing formalities. So that is mandatory for a validity of APA. Otherwise, the same can be cancelled also. So now we understood broadly what is advanced pricing agreement and how it actually works. So now we are going to talk about what are the various steps, what are the various stages with the help of which we can actually use this approach in order to go for the dispute resolution method. So we are having different steps which is given in this slide, in case we can see the various milestones. So how advanced pricing agreement actually works upon. So firstly, we have to file the advanced pricing application. Before filing advanced pricing application, there is one more step, that we can have a pre-filing consultation also. In which case, we are having again a prescribed form like 3C EC. In that form, we actually submit the information with the department, and based upon that, it is actually determined whether the transaction is okay for the advanced pricing or not. And basic information is exchanged. And after that, we can have a proper process to be started. That is, we can file the advanced pricing application in the prescribed form. And again, we have to pay the fees also, which actually depends upon your value of international transaction for which you are actually seeking advanced pricing agreement. So once we file the advanced pricing application with the authority, then obviously it is actually an investigation process. It is actually a fact-finding process. And afterwards, the agreement is signed. So authorities are going to request from the taxpayer the information part, there are set of documents which are requested from the taxpayer. So this information request, it can be asked once, it can be asked twice, depending upon the case and depending upon how the inputs are coming from the taxpayer, whether that inputs require further probing into the matter. So based upon that, the information request is actually exchanged between both the parties. And afterwards, if required, and mostly it is done, the site visit is also done. So what is site visit? That our advanced pricing authority, the tax administration, they will actually visit the taxpayer, and accordingly they actually analyze the transaction. They do the walkthrough of the transaction in order to understand that how the transaction is moved. There can be interviews with the process owners. So it is quite a detailed investigation process where authorities visit the client premises. And afterwards, based upon the information request, based upon the site visit inputs, the draft agreement is released by the authorities, which is shared with the taxpayer. So it is actually a draft. It means obviously it is subject to meetings, it is subject to negotiations, then the discussions happen between both the parties in order to understand, because obviously the taxpayer will always seek that they want to have the pricing in their favor. So based upon that, the actually discussions happen between both the parties. And afterwards, again, in case information is required, the same is requested based upon the site visit, based upon the initial information request, based upon the negotiations. And once the entire process is done, then we have a formal APA sign-off. That means the advanced pricing agreement is signed off for a specific tenure, and that can be implemented actually. Now, advanced pricing agreement always includes some critical assumptions also, because let's say in case assumptions change, the transaction change, then that APA will not be applicable for the said transaction. So that part is always given. In case there is some change, then we have to do the revision of APA also. Same way, in case there is a change in law, when the advanced pricing agreement is signed, the law was different, and afterwards there is a change in domestic law. In that case also, the advanced pricing agreement may need revision. So that part is something which actually happens in case that that particular incident happen, or that particular situation happens. So these are the various milestones of advanced pricing agreement. Like what are the various steps? What are the various stages? So broadly, on right hand side of the slide, we are having the various phases which of the advanced pricing agreement. So broadly, we are having like pre-filing phase, which we discussed. Then we are having main application, which is to be filed. Then fact finding, like information request, then site visit, discussions, negotiations. Then APA signing, that is once it is okay from both the parties, it is actually signed. And afterwards, we are having the post APA compliances, that is, which we talk like we have the annual compliances, which we have to file with the department. And also what happened in case the income tax returns has been already filed, and we have to file the modified return also based upon the transfer pricing which has been decided as per the advanced pricing agreement. So this is the entire framework for advanced pricing agreement. Now, obviously, advanced pricing agreement is a lengthy process, and it requires cost in terms of that we have to pay to department also, which can go to up to 20 lakhs, 25 lakhs, and also we have to pay to consultant also. So accordingly, taxpayer can take they can decide like what to do, whether to go for advanced pricing or they have to take the risk and go through the normal appeal process. So since these solutions are very niche solutions, and obviously taxpayer has to approach the tax consultant, a specialist who can guide the company considering what is the subject, or considering the previous experience, whether advanced pricing agreement can be used or not, can be resorted to or not. So this is all about advanced pricing. Now in the next slide, we are going to talk about the safe harbor rules. So as we just discussed earlier when we are discussing about the alternate dispute resolution matters, so we are having a safe harbor rules also, which was introduced in the year 2013. So what are safe harbor rules? Now safe harbor rules are applicable for a set transactions only, which is given in the law, which is given our income tax law. So what are the various set transactions? So we have just written in the slide, like there are software development services where we can use it. Then we can use it for the knowledge process outsourcing services, information technology services. Same way in case financial transactions are there, like loans are given outside India, guarantees are given, and R&D services like research and development services in the software development. And also in case I talk about the goods part, it can be used in the manufacture and export of components, auto components, core and non-core auto components. So these are the transactions which is given in law where we can use the safe harbor rules. So safe harbor rules, what it actually specifies, it actually gives you margins which can range depending upon the quantum of transaction. Like for software development service, what is the acceptable transfer price, what is acceptable arm's length margin, so that is given in the rules. So that way the taxpayer has to decide whether to go for safe harbor rules or not, because usually the margins are on the higher side. So the planning has to be done, because in case you take the safe harbor rule, it means you're going to have the higher taxation also, but obviously there will be no litigation. So we can discuss like what are the various things in the safe harbor rules. So firstly, that it gives us margins for the eligible transactions. Now in order to apply the safe harbor rules, we have to file a form, which is form 3C-EFA, which has to be filed before due date of filing the return. So what does this form actually signifies? It is like a declaration that I am declaring to department that I want to go for safe harbor rules. So it is a very easy form, like it is a compliance form which can be filed, and accordingly communication can be given to the department. Now safe harbor rules, it obviously gives a certainty, because in case we're using these rules, the margins are fixed. My arm's length pricing is fixed. So it gives us an elimination of possibility of litigation, because if you're using the safe harbor rules, then there will be no chance of litigation, because that is already accepted by department by default. and there is no requirement for comparables and alliance. There will be no transfer pricing adjustments in this case. So in short, we can say that it is like an automatic approval process. It is like in self-assessment process where you are just doing the assessment as per the system which is already given in law. But however, it is applicable for a very limited set of transactions, majorly covering the service part, or in case of manufacturing, as we discussed, in case of some auto components, core auto components, it can be used. So that is, the details are given in the law itself. So this is all about the safe harbor rules. Now, next, we are going to talk about the mutual agreement procedure. So, in our alternate dispute system, as we talked about, we have talked about advanced pricing agreement, the various stages of the advanced pricing agreement. Then safe harbor rules already given in the law, we can use it. We just have to file the form. And next, we are going to touch base the mutual agreement procedure. Now, what is mutual agreement procedure? So, mutual agreement procedure is basically used in case of double taxation cases only. So what happens in case the taxpayer believes that international transaction is being taxed doubly, or there is no proper application of the double taxation treaty, or some assessment order came which is not fair as per law, considering that it is being taxed in the home country also, it is being taxed in the other country also, and that too at a very high margins because of like incorrect interpretation of tax treaties. Then they can seek the mutual agreement procedure. So mutual agreement procedure are basically used in case of double taxation part only. So in this case, what we have to do, we have to approach the contracting states, which we usually use the word CEs, that we have to use the authorities like tax administration of both the countries in order to go for MAP process. Now, MAP process, in case we talk about this process as against the advanced pricing process, MAP process, it actually focuses upon the double taxation cases. And it actually involves a negotiation and discussion between the contracting states itself. But in advanced pricing agreement, it actually involves your taxpayer also. So there is a site visit and all such things. But in case of MAP process, it is actually the discussion happening between the both the states in order to ensure that the taxpayer is not unfairly burdened. So accordingly, the information is exchanged. Even if there is a information request is there is a proper set of information, and again the discussions are held, and afterwards the MAP is finalized. Now, MAP is actually not binding on the taxpayer. That is also a point, because in this case, the taxpayer has an option. Either the taxpayer can go for MAP, or taxpayer may say, taxpayer may adopt that they don't want to go for the MAP. In case taxpayer goes for the MAP, then what is going to happen? Then obviously, whatever things are going on the appeal level, the MAP result or MAP verdict will be applied to that appeal, and appeal proceedings will go on then that will be seized. So that is the advantage in case MAP, whatever verdict comes, that actually is in the favor of taxpayer, what taxpayer is actually expecting. So MAP actually, obviously, because what is happening here, that we are actually approaching the contracting states directly. So it eliminates the need for protected litigation, because we don't have to follow the entire appeal process. And it actually eliminates the double taxation also. So like it is useful in case of permanent establishment also. Like in case I give an example, let's say a foreign company has a permanent establishment in India, and the profits attribution to PE as per the order which has been passed by the Indian taxation authority, that is actually something at a margin which is very high, which is not acceptable to the taxpayer. Then taxpayer can go for MAP, so that the contracting states of both the countries, they can actually decide about what is the fair margin which is applicable here, well, how the profits can be attributed. So based considering this, the MAP process, they can be followable. We can follow this procedure. So there can be a number of cases where we can use a mutual agreement procedure. So these are the things like these are the points which we had discussed, which we can discuss, which we can see in detail in the alternate dispute resolution method. And obviously, mutual agreement procedure also requires a specialist. They require a tax experts, because it is quite a lengthy matter in which we have to approach the contracting states. Now, afterwards, we're going to talk about a Vivad Se Vishwas scheme, that is the amnesty scheme, and we're going to touch base the various amendments introduced by the finance budget, latest finance budget, that is 2025, relating to transfer pricing part. So I'm going to give my mic to Shrushti, who is my colleague. So hi, Shrushti, over to you.
Thank you so much, ma'am. Good afternoon, everyone. Now we'll quickly dive into our next topic, which is amnesty scheme and direct tax litigation, named as Vivad Se Vishwas, also known as VSV scheme. So first of all, why schemes like VSV are necessary? Whenever a litigation comes up, client always think now it's going to be expensive because there are appeal filing fees, professional fees, counsel fees, and if demand comes up, then there is penalty, interest, and taxes. Similarly, on the same side, it is expensive for the government also because of logistics, admin, maintenance, etc. So when a dispute gets stuck into Indian court of law for a fairly long period of time, then it gets detrimental to interest of both the parties. To give you an example in terms of figure, currently the amount of demand stuck in direct tax litigation in India in the form of demand is 11 lakh crores in 6 lakh cases. This is a very, very significant amount. Therefore, with this very intention, VSV scheme was introduced for speedy disposal, settling of disputes, and instant generation of funds for the government. Vivad Se Vishwas scheme is an attempt by the government of India to put an end to pending direct tax disputes. The 2024 scheme enables settlement of tax disputes pending as on a specified date under the income tax law. Now the next question is, what are the cases eligible to take benefit under this scheme? So as notified by the government in notification number 104 in Finance Act 2024, these are the taxpayer who can apply for the schemes. If a taxpayer has a case pending before any level of appellate authority as on a specified date. For example, if a taxpayer has a case pending before DRP, CITA, ITAT, High Court or Supreme Court as of a specified date, the date has been notified as 2nd July 2024. If you have a case pending at any of these appellate authority as on 2nd July 2024, then you can avail the benefit of this scheme. Please note, this is a dispute resolution scheme, so there has to be a dispute. There has to be an appeal pending before the court of law for you to avail the benefit of these schemes. Now let's move on to the benefits. So for the government side, there obviously logical benefit, the instant generation of fund and reduction of workload. For the taxpayer side, the first benefit is dispute withdrawal. Once you have entered the scheme, there are no more submission, no more filings you have to do. Once you have entered VSV, your case stands withdrawn. So this is one benefit, that your appeal gets withdrawn. Second is immunity from proceedings. Under any other appellate authority, once you get the final order, there's always a chance to go to appeal against that order. Once you get final order in Form 4 in the VSV scheme, there can be no appeal made against it. So the cases are closed, the cases are disposed, and appeal is withdrawn. These two are the very major benefits in terms of VSV scheme: immunity from proceedings and dispute withdrawal. So the best case scenario to enter and benefit from VSV scheme is if, for example, you have a case pending in the first appellate authority, let's say CITA, from many years, and the interest has been mounting upon it, then VSV is your best bet. You can decide what arrears you want to settle. You can pay the required amount as shown in this slide. The amount you have to pay depends upon the date of filing of your appeal, the date of entering into VSV scheme, which is the date of declaration and Form 1, and the undertaking you have to file, and the nature of tax arrear. If it is only disputed tax, then it is 120%. If it includes interest, penalty or fees, then it is additional 35%. So this scheme can get you waiver on the amount of penalty, interest and fees. So definitely a very beneficial scheme. If you have long standing litigation, you can definitely refer this. From a procedural point of view, these forms are filed on the income tax portal in Form 1. taxpayer has to file Form 1 along with an undertaking, and the process ends with designated authority issuing final order in Form 4. Once you receive Form 4, it signifies that the appeals are withdrawn and your case has been closed. Hope I'm clear till now. Now we move on to the next part, the last part of our webinar, the union budget updates. This union budget had certain proposal on the TP regulation perspective side. The most significant one of it is the block assessment. The introduction of block assessment. Currently in the TP litigation in India is conducted on yearly basis. TPO issues order for every assessment year separately, and then we have to submit our reply and so on. The new budget proposes that if the related parties and the nature of transaction is similar for a block of 3 years, then on the discretion of taxpayer, the taxpayer can avail this opportunity to conduct TP assessment in a block to cover a period of 3 financial years. Detailed application form and how to proceed in this scheme has not been notified yet. It will come in the due course. And this particular proposal will align our TP regulations at a global par level. The system of block assessment is already practiced in Australia and Canada and so on. This will help the department to reduce the multiplicity of TP audit, and it will also give client a limited certainty. The another update in the budget was about safe harbor. The Honorable Finance Minister has reassured the rationalization of safe harbor rules in terms of inclusion of more transactions and inclusion of more industries. So the safe harbor rules would be expanded to include more eligible transactions, which currently include only 8 to 9 transactions. So to conclude the union budget, both of these moves have been welcomed by the taxpayers community in India, but the success of this would definitely depend upon the administrative implementation. That's all from my side on the Union Budget 2025. I would request UJA French desk to take over.
Thank you all for joining this webinar. We hope you learned thanks to the presentation of Ritasha and Shrushti. So just to tell you as a conclusion that, of course, Ritasha, Shrushti, and our founder, Jen Jain, but also our team, French team, we remain at your disposal. Would you have any queries? Please, you will get the presentation through Rucha, and we put our mails on this last slide. You can also contact us through LinkedIn. Okay, thank you. Over to you, Rucha.
Thank you. Thank you, Olivia, and everyone. I have one question which has come up. So it is, how can businesses ensure they are compliant with evolving documentation and disclosure requirements?
So actually what happens that what we know, the tax part is something which always changes, because there are so many circulars, there are so many notifications which is coming on the way. So the only way in order to ensure that we are compliant with all the provisions, we have to ensure that that is in the safe hands. That is, we are having the proper tax experts, we are having the tax specialists who are actually taking care of these things. So transfer pricing subject is actually a very niche subject, which is not, it is not like every finance person is aware about how the TP works, how the arm's length price work, how TP studies report is prepared. So obviously for this part, ideally we have an in-house team which includes transfer pricing experts, or we have to outsource the same to some transfer pricing specialists, so that we ensure that we are compliant with all the things. Apart from this, we should be aware about all the amendments in case we think that we are having proper in-house team. Then through regular trainings or through regular attending various seminars, and we should motivate our team that they should go to seminars or they should attend the trainings in order to ensure that they are aware about whatever developments are happening in the TP world. And of course, all these things actually happens to actual practice also. So again, it depends upon the complexity of the case where you can decide whether to go for in-house or to outsource. So that way the things can be planned out.
I would also like to add, clients should always have agreements regarding to any international transaction updated and kept with them. There should be backup of all workings of all amounts if there's any intra-group transaction within the entity. So all of these are to be maintained from the client side also, from the taxpayer side also. There are agreements, backup working invoices, because if litigation comes up, then all of these are very important documents.
So I think that is very good point given by Shrushti, because what happens, what we actually see in case of our clients, that they enter into transactions, but the agreement is not there. And during assessment time, the agreement has to be prepared. It is like post-mortem. So that thing has to be done before entering the transaction. Apart from agreement, we should also go for benchmarking process. So what is actually benchmarking process? Let's say I'm going to have some transaction, let's say business support service transaction with my parent company. Then in that case, I'm not sure about the margins, or margins can be discussed simply by negotiation between my company and the parent company. But what is the arm's length price? That thing we can capture by having the benchmark. So benchmarking will ensure that when actual transaction will happen, that is already happening at an arm's length price. Instead, we came to know after the year when we do transfer pricing study, that is something which is like a post-mortem. So agreement drafting, having proper documentation like benchmarking, that will also help us in ensuring the proper compliances.
All right. Thank you, Ritasha and Shrushti. We have another question. For advanced pricing agreements, the benchmarking set by the department is high. How can we match the expectation of the department?
Can you please repeat? Benchmarking set.
Yeah, for advanced pricing agreements, the benchmarking set by the department is high. How can we match that expectation of the department?
So look, what happens in case of advanced pricing? Advanced pricing, it actually includes a set of steps. We are having the various steps which we have to follow. Like there is a negotiation process, there is a discussion process. So it is a two-way process. So department is also talking, taxpayer is also talking. So it all depends upon what documentation you are presenting to department and how you're negotiating your case. That will actually help you to convince the department and have the case in your favor. So it all depends upon the person who is actually handling the case from your side. Because obviously from department side, when we talk about advanced pricing, mutual agreement, the team is very expert. They are not only expert in transfer pricing or taxation, they are persons who are from economics also, law also, statistics also. So there is a technical team from their side. So we have to match the same. And this is also acceptable that the margins which are there in advanced pricing and in the safe harbor rules, they're usually on the higher side because they're providing us the speedy resolution system. So in case you don't want to take risk, then obviously the margins are going to be, the pricing is going to be at higher price.
All right. There's one more question. Are there any industry-specific nuances in transfer pricing regulations, particularly for sectors like IT, manufacturing, or pharmaceuticals?
Okay, in case we talk about an industry-specific, so industry-specific, we don't have any, we cannot say that we are having industry-specific transfer pricing regulations, but there are some provisions in law where they are actually touching a specific industry only. Like let's say in case I talk about a safe harbor rules. So safe harbor rules is very specific because it is applicable for software development services. It is applicable for knowledge process outsourcing. It is applicable for research and development. So that is industry specific. Where in case I'm into IT industry, I can see whether safe harbor rules fits, whether the margin is okay, whether I can go for the same so that I can avoid my litigation. Same way, industry specific is always is very important when we are doing the benchmarking, when we are doing the transfer pricing study, because in that case my all the comparables, my all the benchmarking process, it depends on the industry only. So industry concept is always important in transfer pricing because that is the main thing through which we actually arrive at an arm's length price. And apart from that, there are industry specific judgments also. So in case we are into specific industry and we are stuck somewhere, so that way also we can plan out the things. In case we have to decide about the margins, or there is something about the expat taxation, so that thing can also we can see, because margins always depend upon my industry.
All right, all right. Thank you, Ritasha, Shrushti, Olivia, and everyone. May I now please ask Tracy to give the closing remarks?
Thank
Or
you,
Olivia,
Rucha. Sure.
would you want to share a closing remark from UJA side?
I think I already said that we are at the disposal of all the speakers if they have additional questions. So, and I thank everyone for staying with us until the end, which probably shows that Ritasha and Shrushti presentation was appreciated. Thank you again to you, Rucha and Tracy, for organizing this webinar. We are thankful. So Tracy can still say a word, maybe.
Thank you very much, Olivia. Thank you, Ritasha and Shrushti, for that insightful session. That was very, very interesting. Our deepest gratitude to UJA Global Advisory for their partnership in this knowledge sharing session. I'd also like to thank, like Olivia said, I would also like to thank all the audience for staying with us and being part of this session with us. We request you to kindly fill up the feedback form and a survey which will be sent to you after the webinar. Thank you once again and look forward to seeing you at a future webinars. Thank you.
Thank you.
Thank you, everyone.
Thank you everyone.